So hello here and welcome. I'm your host, Konstantin Kogan, and we're at Holistic Investment. And it is my pleasure to have here today Jake Brukhman, who's a founder and CEO at CoinFund. Hi, Jake.
Hi, Konstantin. Thank you so much for having me on.
Thank you for being here. And traditionally, we'll start with a disclaimer. So this content is for informational purposes only. You should not construe any such information or other material as legal, tax, investment, financial, or other advice. So Jake, you've been like one of those people who I can call probably like, the crypto OGs, right? Now, like you started pretty early and you're very knowledgeable specifically in DeFi context, and your fund is doing great, and we're going to talk about it today. So I know that one of your favorite topics is like, DEX and DeFi and the growth of, different aggregators and different new layers. And I know you've made a bunch of great investments out there. So before we go there, also, like, this is just a pre-announcement. So can you like just explain our listeners like a little bit like about your personal story? How did you get to this crypto rabbit hole?
Absolutely. I'm happy to tell you. So I'm a technologist. I have a degree in mathematics and computer science. I went to Rutgers in New Jersey in the math program, and then I was at NYU Courant Institute of Mathematical Sciences. I've always been like a professional, almost like early adopter of technology. So I had like a mobile phone pretty early. I had like the first iPhone back in the days when you couldn't really hear anything through it if you were in New York because the street was like just too loud, and it wasn't loud enough. And I got introduced to Bitcoin like pretty early in 2011. So in my career, I worked in mostly in the financial technology space. I did a stint at Amazon as a technical product manager and engineer for about 2 years in ad tech. But other than that, I worked in hedge funds, doing quantitative research and trading. And then I also worked as a CTO of a fintech company called Triton Research, which did some pretty interesting research on pre-IPO private technology companies. What we did was like kind of source public information about them from the internet and reconstructed their financial models. So that was like a very interesting problem in business. And then, like I said, along the way, I learned about Bitcoin. I became an investor in Bitcoin in earnest, probably like late, I think it was November 2013 on that upslope to 1200, and was just kind of watching the space ever since. And then I, was mining Ethereum in the early days. I think CoinFund mined one of the very first blocks on Ethereum frontier. I think a couple of blocks in the first 1,000 there. So CoinFund's been around, and as a fund, this was sort of my strategy to get exposure to blockchain. I wanted to work in this exciting growth area full time. I got the sense that I probably shouldn't do a startup yet. Like this technology is going to develop quite a bit. That theory turned out to be true. Became an investor, and so that first fund, was really one of the first U.S.-based funds, really in the world.
What was the year?
It launched July 1st, 2015, and it was one of the first funds that considered digital assets as an asset class. The story I always tell is I read Vitalik's white paper at work one day, and then I kind of put it down and looked at the wall for 30 minutes and thought about tokens, and was like, yeah, that makes a lot of sense. That's very interesting. And so, so that fund really looked at that kind of asset as a new asset class. And it's really funny, like the very early kind of like white papers for CoinFund, they only referred to cryptocurrencies because they're, that was the only like kind of blockchain primitive available. But later you got tokens, and the design space of digital assets became so interesting. So that's a little bit about me. But since then I've been working in blockchain full time since early 2016. We're now about to raise our fourth fund on our platform. We've had a lot of interesting kind of success as investors across different funds. Partnered with Venrock, big VC firm here in the U.S., originally money of the Rockefeller family. Work with David Pakman from Venrock pretty regularly on investments, and just really plugged into all aspects of the blockchain space.
No, it's great, and I know that you've been like if you actually started in 2015, that means you're probably one of the first 50 funds, like in the world, actually. Like, so that was a statistic. So that's impressive, and I'm sure you've done a lot of research, you've done a lot of great like due diligences of projects. So if you were to quantify like this journey like in 5 years, right, from 2015 to 2020, so can you talk about the progress where we were like with the cryptocurrency stage, as you said, like it was primitive in a way, like, and now we're talking about like a different tokens, like stable coins, like different crypto assets. Like they're not like one or two, there's like, dozens of them right now, like different categories, not even talking about like thousands of different coins. So what is your primary focus like of your fund, of CoinFund? And what is your strategy, if you can take it, because I know you have a pretty interesting, innovative strategy.
Yeah, I would say, like we've called it network lifecycle investment in the past, but essentially the core thesis across all of our funds. I mean, today we're more like a fund platform with a bunch of different funds, but the core thesis that kind of unites them is this idea that crypto networks are really disruptive, new organizational structures for services that are highly, highly competitive with kind of traditional companies that are the classical providers and middlemen and provisioners of all the services that we use today, right? And to make that a little bit more concrete, Amazon provides cloud storage, but in the future, cloud storage will be provided by a decentralized network of small and medium providers who are all united in this blockchain-enabled network and has a native asset that captures the governance and the value accrual of that network. So the core thesis of CoinFund is investing in such things, and also the traditional companies that enable this stack to flourish. And these companies are, CoinList for issuance, they're Blockdaemon for running network node infrastructure, their sort of exchange infrastructure, their banking services. They're crypto-enabled companies that are using some of these value propositions of crypto networks to create highly competitive businesses. And as a matter of fact, on my blog just recently, I published this post called "What We Look For, the 9 Core Value Propositions of Crypto Networks," that really kind of explains exactly what those properties are. Now, the interesting part, Konstantin, is that, just like companies have a life cycle, networks also have a life cycle. They start as a couple of people, founders come together, they start a pretty traditional entity, they might take a little bit of venture capital, and they create grand plans, for this network. And then they build the network and kind of put it into testnet and put it into production. But this is a very early stage of the network. Like, it requires bootstrapping, it requires capital, it requires liquidity, whatever the case may be, right? Like, it needs to actually come up and become functional. And this is the second stage. It's called the bootstrapping stage. And then once that network starts providing service and achieves a little bit of product market fit, and we do see a couple of areas, amazingly now, especially this year, that are achieving or starting to achieve real product market fit, then those networks become more mature and their assets become higher cap, more liquid, right? And then they become sort of more mature production assets. So these 3 stages of the network lifecycle is what we cover at CoinFund. We have Seth Gins, one of our partners, runs our CoinFund Liquid Opportunities Fund, and that covers more of that later mature liquid stage. And then sort of our hybrid fund and our VC fund are going to be covering the first 2 stages, like pre-seed, seed, Series A investments, in these networks and their key enabling infrastructure. But also, very non-trivially, that second stage of bootstrapping is now becoming a huge area for investors, because networks, they want to hear that investors are actually adding value. They're actively participating in governance. They're increasing liquidity on the network and helping the network succeed. And so we've been doing that discipline also since about 2018. And our funds also like very actively participate in that stage.
So let me ask you like more, I would say, in particular, the question, like if you would compare it to traditional VC, like you as a company who is professional, what do you do? And you know how to do diligent networks. And, you know, there's a typical criticism, like how many networks do we need? Like, you know, that probably not more than 10, right? You know, the big one. So the question is like, how do you even evaluate the opportunity when you're entering the deal? Like, you know, and the other, like, I would say subsequent question is like, if you were to compare the difference between traditional VC investment in the equity of the company and investment in the equity or the tokens, you know, specifically, what would be the major distinction, like for some people who never did that before?
Yeah, so let me take the question one at a time. So we are a thesis driven and trend driven fund. And let me explain what I mean. So when, you know, this is a highly technological space, and we're making highly complex digital technology and economic technology, which is also a new area. And what we see in every vertical of blockchain is essentially this exponential innovation curve. You know, someone comes around and creates Uniswap, and someone else comes around and innovates on Uniswap, and that's Balancer with multi-asset portfolios. Then someone comes around and innovates on both of those because they want to try to minimize this problem of impermanent loss that decentralized exchanges like Balancer and Uniswap have. Then someone else is going to come around and like add other features, right? And so if you're a technically minded investor, then it is fairly easy to look at the technology, look at sort of what's in market, look at what's feasible, look at the trend of where things are going, and make a prediction, a pretty educated one about like what's going to happen next. I mean, like one thing that we thought was going to happen at the end of 2016, I remember writing about this, is that DEXs were going to capture a bunch of liquidity in 2017. That did not happen until this year. It's 2020, right? So we definitely underestimated it a little bit. But this year, what happened is this innovation curve went into effect. AMMs really hit market. They discovered liquidity mining programs. They got a ton of liquidity. And now, I think the 24-hour volume of DEXs has been about 1.2 billion. I checked earlier this morning. And it was literally like 6 months ago, it was like literally a few million a day. So that's like incredible growth. And by the way, there's something like, you know, 100 to 150 billion dollars of exchange volume in blockchain at large. And so these DEXs have this huge addressable, addressable volume to hit. So as a fund, you know, we look at these trends, we look at these innovation curves, and we invest alongside of along those curves, right? Like one dimension is time. You have to keep investing in the technologies as they keep innovating. And then also another aspect of blockchain is that it's such a widely applicable technology, right? So it's almost like a database. A database is applicable in essentially any industry, and so are blockchains. And so like we find ourselves investing across verticals all the time, and we're not like, you know, the typical tech fund will be like, oh, we're an AI fund, but we don't do that. We have to do AI, and we have to do financial services, and we have to do insurance, you know, and we have to do art marketplaces and everything like that. So we find ourselves being generalist investors. So I hope that answers your first question. And I think your second question was about, was it equity versus tokens?
Yeah, well, I'll give an example. For example, if you were to explain, imagine there's an LP, you're a potential investor, a limited partner who wants to participate with you in some deals, right? And who trusts your expertise and loves your thesis, you know, and understand that you guys are smart, you've been successful. But now, just if you were to explain such person, like who's genuine, can be a fan, enthusiast, right? But does not understand all the technicalities, like, you know, when you say like Uniswap, where it's not easy to explain. It's like, you know what, as decentralized exchange is basically, if to simplify the what it is, right? It's like a market maker, like, you know, just like it's on chain, and it's like, you know, two different smart contracts, and then you have to explain what is ERC20 tokens, and etc. So as you mentioned, it's like highly technical and very, like, you know, the peak of the iceberg, like, of all the innovations in the space. But you still have to apply, you know, language, human language to explain it, right? So how will you do that? Like, to just maybe find some traditional examples so I can and explain your thesis.
Absolutely. I mean, I think the way to explain crypto networks in sort of common language is just to say, look, this is a different, almost not a corporate structure, but a different organizational structure for a business. And that business might be cloud storage, it might be computation, it might be domain name registration, it might be a marketplace where logo designers design logos for you, whatever it is. But marketplaces, right, are like a huge component of what blockchain disrupts. And so once you put a marketplace into the format of a decentralized network, you actually have a very traditional business model. And that business model is that the provider of the marketplace assesses a transaction fee on the people who are transacting on that marketplace. And once you have that traditional business model, that creates a cash flow. And that cash flow is captured in an asset. And of course, that asset is a digital asset, which is the native asset of the network. So in many ways, you can probably simplify and really oversimplify the idea of crypto networks and digital native assets as stocks of decentralized businesses, right? Or equity of decentralized businesses. But of course, the reason that that's an oversimplification is because, stocks and bonds and like traditional instruments, they have a very limited design space. And what we see in crypto networks is the way that you can design these digital assets has a very rich and really infinite design space. And so we'll see things like stocks, but we'll also see, governance tokens, we'll see utility tokens, we'll see payment tokens, we'll see stable coins. We see a whole zoology of different assets, and how they capture value is totally and utterly different. And so that's what makes blockchain analysis so interesting.
No, you're totally right. But that on the one hand, it's a positive side. On the other hand, it makes it a little bit more complex for anyone who's new to the space. He needs to basically go over all the taxonomy of the crypto assets and understand why they're there, like what's the value, like, how you calculate, it's not your typical like ROI, EBITDA and other parameters, right? So you need to understand technical aspects. So that, I think it slows down a little bit the adoption, right? So if I were to ask you, like, right now we're seeing like increasingly high numbers in DeFi, like just like the volumes, the per day, like, and, generally, like, the adoption is coming out. But I spoke to some traditional friends, coming from the investment banking. They're saying like, well, the reason that's happening just because we're now considering it as a lending, like, as a Klondike for lending, because of course banks cannot allow you to pay out like 8% per annum, right? So like, which a lot of the protocols, as we know, like, just like you're staking or you're lending your crypto asset, they allow you to do that, right? So I know that you've made some prominent investment in this space, so maybe you can talk a little bit about like to emphasize the add value of such existing protocols.
You mean in lending in particular, or just in DeFi in general?
In DeFi in general, like, why do you think is DEX like right now is becoming like, so well adopted, and the traditional folks like from Wall Street are also stepping by, like Vanrock is a good example, as you mentioned.
Yeah, I mean, look, a lot of it also has to do with who the participants are and how and what is the process that blockchain is going through in order to become adopted. And so my mental model, well, first of all, let me just say this. So we always thought, and in traditional investing, we always think, right, that there are these like three layers. There's like the base layer, like the infrastructure layer, and then there's dApps. I'm now more convinced than ever that there's no such thing as dApps. And there's really no such thing as base layers either. I think it's all just protocols all the way down. And then what you have on top is this like tiny thin layer of interfaces. And what you'll have later is like more traditional companies or businesses building on top of that. So this is sort of the process we've been going through. We've been like building layer upon layer upon layer of protocols. We started with base layer protocols, then we started with like DEX protocols. Now we're in the aggregation layer where things like 1inch and Paraswap and Zapper are actually aggregating multiple transactions. And really, this has all been sort of a building up to the top toward the consumer. And what this does is it creates two kinds of users in blockchain. There are the crypto native users who are really versed in like how these protocols work. You know, they know how to use MetaMask. They know about blockchains. You know, they can manage private keys, and most importantly, they can be active participants in the protocols. These are the people who are adding liquidity, that are being on the supply side of all of these things. And then, of course, there's the early consumer adopters who are much less technical, much less savvy, and we've seen relatively little adoption, you know, from them. But of course, we're always on this road to deliver products to them. And I actually think we're very, very close. Given what we've seen in DeFi, we've now created enough, first of all, value propositions that we can put in front of regular users that they can understand. And second of all, experiences and throughput and scalability and user interfaces that they can actually use like they use traditional apps. And what that looks like to me is very simple, Konstantin. It's just a bank app. It's a challenger bank app in your phone, which provides for you very traditional financial services like a money market account where you're earning a nice return, not 70 basis points like at Goldman Marcus, but actually more like 5% APY. It's a place where you could borrow money by depositing assets. It's a place where you can maybe get insurance, you know, for certain things. It's a place where you could play a lossless lottery. It's a place where you can invest your crypto in general, right? And I think like that product, the wallet, where a mainstream user can do that without having to worry about keys and without worrying about kind of the onboarding from dollars into crypto, like that's going to be the first really killer consumer app in blockchain, right? And so our investments in DeFi are anticipating that adoption. And we've made a couple. At the end of last year, we invested in Balancer, which is a decentralized exchange. We invested in Union Protocol, which is an unsecured on-chain lending protocol, as well as Open, which is an options / insurance protocol. And we're also in the process of making a couple of DeFi investments today. Recently, we announced our investment in Zapper.
So now let's go into some examples, right? And of your investment portfolio, and how do you approach, you know, like in your investment thesis, like, you know, to why to invest in those, right? So I don't know if you heard, but I'm sure you know, like Ivan in Tech, you know, who's a popular like blogger in this space, like, and he recently announced like there was an interesting like episode where he's saying that, you know, like there's a lot of like the DeFi bubble is almost like a scam, like, you know, the way it's running now, like a lot of the numbers are artificial and etc. I mean, not to go over too deeply into it, but he compares, like, by the way, like, you know, Uniswap, Balancer, and some other liquidity pools, like, you know, between each other, and explains the downside, right? So if you were to explain someone again, like, you know, the basic difference, like let's start from Balancer and Uniswap, right? You know, why do they exist? Even, like, you know, what's so special about them? And why did you decide to invest in them?
Absolutely. So I think, like, you know, creating an exchange in the format of a decentralized crypto network is like very democratizing. So I think like one innovation on the supply side of those networks is that, like, if you want to be a market maker in the real world, you have to go deal with order books. You have to write software that very actively manages your position. You're taking on like a lot of risk that is very hard to quantify because it solely depends on this bespoke strategy that you're undertaking. You need a lot of capital, and there's a lot of complexity being a market maker. When you go over into the DEX world, in the context of an automated market maker like Uniswap or Balancer, you can be a retail person who just deposits some assets. And then it's an incredibly democratizing thing to be able to join the revenue stream of an activity that traditionally has only been available to the richest, you know, most sophisticated players in the market. Now this activity is democratized and available to everyone. I mean, it's not perfect. It has risks. You know, absolutely, like, do your own research before undertaking this. But by and large, this is a hugely democratizing technology. Secondly, there's a very important property and core value proposition of decentralized networks, and that is this idea of permissionlessness. When you open up this network in that way, when you allow essentially anyone to come in and to create a pool for an asset, it's sort of like crowdsourcing. And the net effect of this is that this decentralized exchange is going to create the best coverage of assets that you've ever seen, right? So the traditional problem with all liquidity venues in blockchain or otherwise, right, is like, how do we aggregate enough liquidity to make this market actually worthwhile for our customers? And the way that AMM solved that is they have these incentive programs called liquidity mining programs that essentially incentivize anyone who who has the token to go and create a liquidity pool for it. And as a result of Balancer's liquidity mining program, I mean, we have some of the widest coverage of assets in Balancer on the market. Now, if you rewind, I mean, you've been in blockchain for a long time too, Konstantin. If you rewind like a year ago, or a year and a half ago, the average outlook for a token is like, oh, it's probably going to take 6 months to list in some Asian exchange. Founders are probably going to have to pay money for that. And
then
once
there's going to be a pump and dump,
There's going to be a pump and dump. You're going to have to pay some market makers to create liquidity. And by and large, there's going to be another period of a few quarters as the liquidity in that asset gets to an appropriate size. Now, what we're seeing in AMMs is that a token can create tens of millions of dollars of liquidity overnight using these mechanisms. So in a way, the reason we invested in this is just because it is a democratizing, open, efficiency technology for exchange. And the growth in DEXs, as I mentioned before, has been uncanny. I think it will take over very quickly in the coming quarters.
Yeah, so AMM, just a reminder, automated market maker, right? For someone who's not familiar with the term, and so generally, the value proposition, I shared fully. I just wanted you to explain it as a person who's really involved in it deeply, and I think democratization is where we're supposed to go eventually, right? Even though it's very early, and there's we would probably have a few million people who actually use it, day to day, and some others who know about it, and they're not a frequent users, right? Not in they probably bought some crypto and they know how to exchange, them from one cold storage or hot wallet to another, but they're not that sophisticated. So my question to you, with the appearance of Balancer, Zapper, and all other great protocols, which is still they require a lot of technical savviness, right? So what needs to happen so that the adoption will go to the next level, from early stage adopters to to more more massive adoption?
Yeah, I mean, look, I think what we see everywhere in DeFi is this primitive of yield, right? I talked a lot about this concept of generalized mining for the past 2 years, which is the idea that people can go to protocols and generate alpha by engaging on-chain protocols directly. Now, the first set of opportunities that came onto the market was staking. And what you'd see is they would say, hey, if you run a node, or if you delegate your asset to a node, you're going to capture some of the inflation rewards of the system. But inflation rewards aren't true yield, right? There's all else equal, no value is being created in the network, and dilution is happening. And so, so really, this is just a way of betting on the dollar-denominated appreciation of the asset, and also maximizing your exposure in your position. Now, what happened after that is that DeFi came along and started creating true yield. So when you're lending money in a lending protocol like Compound or Union, right? People are actually paying you real interest for the service of lending them the money, and that's true yield. And so you, as a very high level opportunity, you can wrap up a lot of these DeFi opportunities as simply here's a yield that you can make by depositing a certain asset, and here's the risk that you take by depositing that asset. And if you can formulate a lot of these opportunities that way, then you can present them to retail investors at a very high level and say okay, this is the money market where you'll make 20%, but here's the risk rating, and then here's a much safer one where you make 5%. But you know what? Even 5% is better than what you're getting in your bank account today. And that's why I think it's such an interesting value proposition. So a bit of that simplification has to happen, I think.
Now, like for some like pundits who's watching it, like, and probably they're still like denominating everything in dollars, right? And when the biggest criticism I've heard, like, which is very typical, like when we're saying like 5%, 8%, whatever that might be, which is exciting, obviously, which is higher than any traditional institution can provide you. At the same time, what they're saying like is essentially, well, guys, well, with the volatility that you're offering with your like shit coins, right? That my 8% may end up like, in a loss, right? And like, even then I wait for 1 year, I wholeheartedly stake, and I believe in the project, but the project itself or the protocol might not perform well. So how do you mitigate those risks, like, because right now, if you can give some practical examples, like, people who are staking, let's say they're taking yield in Bitcoin, they're taking yield in whatever stable coin, or they're taking yield in some alternative crypto assets.
Yes. I mean, I think the basic distinction, I think you laid it out quite well. The basic distinction is, is your asset volatile or is it stable? So I think if someone is new to blockchain, and they're not fully cognizant of the risks, they're not fully comfortable with the risks, a very basic thing that you can do is you could just take some dollars, you could send it to your, let's say, Coinbase account, convert it to USDC, which is the digital on-chain version of dollars, and then you could put it into some kind of deposit or yield, yield opportunity, and that way you don't take on weird token market risk, right? You're just kind of dealing in dollars and you're enjoying, most likely a better rate that you're enjoying in your bank. And that in this world of COVID and money printing globally, right? Like it's almost like you're silly not to be doing that at this point. Now, as people get more sophisticated in blockchain, and I've seen, I've worked with a lot of people who are my friends and my acquaintances who I've gotten into blockchain, then worked with them to kind of understand how they think about it, to help them navigate the space. What I see is that when people get a little bit more sophisticated, they realize like, hey, there's some interesting risk reward opportunities in blockchain, and maybe I can allocate a little bit of my capital to a volatile asset. And once you've made the decision to be long in a volatile asset, then it becomes silly not to put that volatile asset to productive use, because you're taking on the market risk of it anyway. So you might as well deposit it into something that gets you a true yield and mitigates the volatility that you're taking on. And so in both cases, like, it kind of depends on who you are, what you want to do. It kind of depends on your risk tolerance. But once you're in, I think, these kinds of DeFi opportunities are actually quite interesting for mitigating risk itself.
Now, if you were to take yourself in the shoes, like because I get like, I get this question a lot from friends, who want to get in. They don't know yet, like, what is DeFi, like, and how do you consume it, right, with what sauce, but they're interested. They're reading a lot of articles. They're genuinely interested. And they say, well, I'm not ready, like, the fund minimum typically is like at least 100K, right? They say like, it's too much for me for now. Like I want to try it with 10, 20K, just for the sake of example, right? And where would you advise me to go? Like, and I'm always like confused, first of all, I cannot give you any best advice. Like you have to research yourself. However, like you should read all those articles, right? And by the way, one of them I've sent your article about the DeFi protocols and just imagine yourself like who's starting like this new journey, right? And you don't know how to even assess the risk of the highly volatile like crypto assets. Like where would you start? Like one thing we've mentioned, like okay, you buy USDC on Coinbase. It's a very safe harbor, right? You cannot go wrong with that, right? So well, again, this is not an advice, but like there's less risks, right? But again, we're talking about like some other like tokens which are more volatile. Like where would you go to even read about them, like and understand like what will be your first investment?
Yeah, and I'm actually a terrible person to ask about this because I often don't take the the consumer view of these things. I'm very like in the weeds. But my impression actually has been that a lot of the YouTube folks have been doing a great job of sort of highlighting the functionality behind some of these assets. Now, you should be extremely careful You should be very cognizant of the fact that whoever you're listening to online might own tokens and might be biased in certain ways, right? And you should always like double check the research across a few sources. If you're technical, you should read the smart contracts, et cetera, et cetera, et cetera. But a couple of concrete resources would probably be there's a gentleman named DeFi Dad on Twitter.
Yeah.
I think his name is Travis, and he makes great videos about DeFi where he shows you how to interact with some of these protocols like Wi-Fi, what they're supposed to be doing, because it could get confusing sometimes. And I highly recommend checking out something like that. You mentioned Ivan on Tech. I have a friend who, for a long time friend of mine, who like loves Ivan on Tech, and he rants and raves about his videos all the time. And then, I do think that in the future, like a lot of people will put, a lot of consumers or like kind of higher level people will participate through managed interfaces. So if you look at products like stackedinvest.com, right? This is somewhere where you can buy an index of tokens that are volatile, but you could use your credit card to do it, and you don't have to worry about holding it in the wallet and whatever, unless you want to. I suspect that in the future, and I think today, Coinbase might have like deposits where you can earn a DeFi style APY, and hopefully in the future, products like Coinbase will be looking through to protocols like Zapper to get kind of the best APYs and the best opportunities, going forward. So I think like managed products and just kind of getting out on social media and doing a little bit of due diligence goes a long way in DeFi.
Okay, so we went through basics because that was a request, so now we can go to Zapper and go more technical as you love right now. So tell us about your investment in Zapper and tell us, why do you think, again, it's the next big thing?
Yes, so a really strong signal for me as an investor is like, if I'm using a product 200,000 times a day, I want to like reach out and talk to the team. And so I really found myself searching for a DeFi dashboard. There are a bunch of them out there. And I have to say, Zapper was just the one that achieved kind of the best coverage, period. This problem that you have in these dashboards is that like they'll support like 80% of the assets in your wallet, but not 100%. So you're like looking at 80% here, but then the long tail, you got to go to that one, but they don't support others. So you never really know exactly how much money you have in your wallet. It's very, very annoying. And could be dangerous, right? Like you could be missing opportunities. So what I found is that Zapper really just created kind of the best coverage of integrating with smart contracts, allowing you to use them easily. You could, for example, go into liquidity pools right through the interface. You could do staking rewards right through the interface. And so I reached out to the team, and with the mind that like, oh, this is a centralized company doing a very traditional dashboard product. And what I found out was that, as a matter of fact, Zapper is doing a decentralized network. So they have this. It's totally not obvious from the interface today. We're not yet in that phase. But what's happening on the back end of Zapper is this idea of things called Zaps. And Zaps are basically a way of aggregating any number of DeFi transactions into a single Ethereum transaction. That really simplifies the way that you can interact with DeFi and yield-bearing opportunities. It also saves you a ton of money on gas. And the fact that this is a decentralized marketplace of people, of engineers really, who create Zaps for people who are users who use Zaps, I think is super strong because of that core value proposition of permissionlessness. I think very soon we'll see that there are just thousands and tens of thousands of different Zaps that people can use, and they will evolve and optimize opportunities as the market evolves. And I think that this format of an open network will create the best possible coverage of all DeFi opportunities because of this permissionless self-service property that it has. And so once I heard that narrative, I said, there's just one last thing that we need here, and that is a token. Will Zapper have a token? And it turns out that Zapper is going to be one of the first marketplaces that has this concept of volume mining, which is using token incentives to encourage people to transact on their marketplace. And when I heard that, I was like, that's it, I'm sold. And we made the investment.
So if I may ask you just a clarification, so because my biggest concern was also like the payment of like high fees, because essentially gas is what is like, you pay a network fee, right? So how in a percentage, percentage wise, how much are you saving if you were going to use like, the Zaps?
Yeah. I mean, frankly, these days it could be quite a bit, right? So, like, imagine a transaction. Imagine you want to do like a complicated set of steps in DeFi. Let's say you want to put some Ether into Maker. You want to withdraw a loan of DAI. You want to put that DAI in a liquidity pool, and then you want to take the LP shares and put that into a liquidity mining program. I mean, you're talking about like 4 or 5 transactions to do that. I might not even be counting approvals, right? So you might have 6 or 7 transactions there, and for each of those transactions, like right now, you're going to pay like at least a few dollars, but sometimes, like the last week has been really expensive. It could be as much as $100 for.
It depends on the volume also, right?
It depends on the network traffic and a lot of other factors, Ether price, all these kinds of factors. Now, what a Zap would do is it would take those 7 transactions and collapse all those 7 transaction fees into one. And that one transaction fee might be slightly bigger than every individual one, but altogether, if you sum them up, you're doing like an awesome cost savings, right? So that's how Zapper works. And then for the convenience of that, I mean, that creates a margin, right? So for the convenience of that, you might be willing to pay Zapper a certain fee. Mm-hmm. Even more than convenience, and I go by my dad, who dabbles in DeFi, obviously, because I told him about it. But my dad, he's not like a super sophisticated user of DeFi, and he gets it, but it's like sometimes hard to reason about all these different interfaces, about what does it mean to have LP shares and staking it here and putting it there, and why isn't it not in my wallet? And so when he discovered Zapper, he was like, you mean I have a single button that I can just press and that gets me my rewards? And I'm like, well, yeah. And he's like, great, I'm never going to use anything else, right? So that convenience factor, I think, creates a lot of like brand affinity and product affinity with users who are less sophisticated, and I think it's likely to be like pretty sticky.
No, I'm 100% with you. Like I hesitated to use it, to be frank with you, but after this interview, I will use it 100%. Like, because not only is it, I love user experience, but also like, as I understand you, like you're essentially, you can like match 5 different transactions into one, right? And that's so the cost efficiency comes from, right? So,
or I'll give you another like really, really practical example, right? So a lot of times people move capital between pools. Mm-hmm. So you have to like, I don't know, take Ether and Ampleforth and put it into this pool. And then when you're done with that investment, you got to take it out, convert it, move it into a different pool, right? And it all becomes like many different transactions. On Zapper, you can do this thing called rebalancing from one pool to another, meaning you can take some capital that's in a pool and just transmogrify the shares of that pool into the shares of another pool, and you don't have to worry about the details. So that's another great feature.
Wow, that's impressive. I'm definitely gonna try it out, right? So you mentioned also another topic like into liquidity mining, right? And we talked about like what's like different. If you can talk about a little bit different crypto economic mechanism and like and how do you build your investment thesis around it? That's interesting to know as well.
Yeah, absolutely. So my really the example in my mind is Balancer. Like what we saw the Balancer team do this year has been pretty incredible. When we invested in Balancer last year, we certainly asked about tokens, but the feedback from the team was, maybe we'll have tokens in the future. We sort of want to see how the market develops and what the right model is, and we thought that was correct at the time. And then Balancer launched in February. They launched their kind of swap interface, very similar to Uniswap. It kind of sat out there. We tweeted about it, but usually, pretty much like nobody really cared in the space. There wasn't a lot of activity. And then what happened in May is that the Balancer team noticed that some of these liquidity mining programs were coming to market. Compound, of course, was first, and they announced a liquidity mining program. They didn't even implement it. They simply said, guys, if you start adding pools to the network, if you start adding liquidity, we're going to take note of your addresses, and then later we're going to launch a token, and we're going to pay you in arrears for some rewards for this activity. And as soon as they announced that, before they even implemented anything, activity on the network jumped 10x in every KPI. I mean, like number of pools, number of liquidity providers, number of assets, volume, revenue, like all these KPIs went 10x. And then about 3 weeks later, they actually surprise launched the token at lunchtime one day. And as soon as that happened, and the token aggregated liquidity, like millions and millions of dollars of depth of liquidity in like an afternoon. And it was like almost like something that we've never seen in blockchain before. It just aggregated liquidity on its own platform. And as the token went liquid and these rewards became real, all those KPIs went another 3.5x. So all in all, in like a span of 5 weeks, we did like a 35x of all of the fundamental activity on the network. And then if you could pull up the Dune dashboard and you could see all the growth that happened since then. I'll read you the numbers as they stand today. There's something like $500 million of cumulative balancer liquidity. There's $1.7 billion of all-time volume. This is for a project that launched in February. There are, just over in the last couple of days, we're over 1,500 unique daily active LPs. Anyway, if you want the details, you could check out the dashboard. But the point being is that this program became a highly competitive vector for the Balancer project. It achieved tremendous coverage. It achieved fundamental activity. And of course, it's generated a bunch of revenue for LPs. And so as investors, we're always concerned with this idea, like, are we creating fundamental value in these often speculative economics of projects? And I think the answer is a resounding yes. If you take a look at Compound, their speculative economics caused a bunch of fundamental activity in the platform. Fundamental activity was created commissions in the protocol. And in the future, the token holders of Compound might vote to redirect the revenue of the protocol to token holders. And that will be a future cash flow. And suddenly, you're in a position now where you have a token which has a very, very traditional and financial model of how to value this thing that might be applicable in the future and could easily be analyzed using traditional tools. And of course, that being said, the space has been very exuberant. Multiples are high. Like, there's a lot of high expectations. But I think, like, over time, we'll develop really standard models of how these products come to market, and we'll have like very concrete valuation frameworks for the assets that accrue their value.
Yeah, those are great numbers for such a young project. I mean, you're right. It's and it's not one example or two. There are many of projects that are booming right now. So just to also understand the basics, when you mentioned you're investing in something like some project like Balancer, right? So are you still invested in equity of the company, or there's some combination of things?
It's a great question. I think, like, on average, sort of the idea of soft notes has started to kind of go out of style. And I think the more common structure that we see as investors is this idea that you become an equity investor in kind of the founding team. And then as an equity investor, you get prorated into the token supply in some way. And this is also advantageous because, in my mental model of how the teams operate it's often like this. Like, they'll create the decentralized network, but then later they're going to want to go build a proprietary business on top. Maybe they're doing consulting. Maybe they're providing whatever nodes or infrastructure, whatever value-added services they want to do on top of the network. That's going to be a traditional business funded by traditional equity. And the fact that they had that equity already in the first place and you're already an investor there just helps to align everybody's interests. So that's a more common model we see these days, is like equity plus proration or conversion into tokens.
No, it's good to explain, because a lot of people expect, like, I think there might be some confusion when they hear, like, oh, a decentralized distributed network, the idea that they have no shareholders, right? The idea that it belongs to the people, right? At the same time, they hear, okay, just traditional fund just invested in the project, right? So there is like confusion there, and it's good to understand it from the person, from your perspective, right? So now we can actually go to, I know, to the topic which I told you openly, like I'm not a big fan like of the NFTs, like, and I have my own reasons for that, but I'm still eager to learn. And I know that one of the topics that excites your investment in Dapper Labs, right? And then generally like the marketplaces and like the combination of NFTs and the DeFi, they go well together, right? So
Yeah.
maybe you can talk about about your thesis about why do you think the space is going to grow, and specifically this angle.
Absolutely, and maybe I could provide a perspective that that might be interesting for people who aren't as close to space. And here's the perspective, right? Like, it's really easy to mistake what's happening in NFTs right now as a bunch of people trading cat pictures on blockchains, right, for money.
Yeah.
And when you look at that way, like, it seems a little bit silly. But here's my theory about what's actually going on here. What's actually going on here, like we often hear this question: why would I pay for blockchain art when I can just right click on the image and download it to my desktop and put it on my desktop? Like, why would I pay for it? And the answer is because you're not paying for the image, you're paying for the intellectual property rights to that image, which is a very, very different thing. And so when you frame it that way, what you realize is that owning the rights to some digital content is actually very powerful, because it confers all these rights to you. You can own it, you can sell it, you can lend it, you can earn a royalty stream on it, you can put it in a museum and they'll pay you kind of a fee for doing that. You can get it licensed in the movie, and then every time the movie plays, like, they're gonna pay you a little bit of money for that, and so on and so forth. So if you look at NFTs as digital property rights, then what's actually happening here is that we're dealing with an asset class, a financial asset class, not cat pictures on the internet. That's point number one. And point number two is we're completely underestimating how much digital content there is. There's something like 2 billion images that are uploaded to the internet every day, but there's like 100,000 albums that come out every year. There's like 200 billion tweets that happen every year. There are marketplaces for 3D models. There are marketplaces for stock photography. There are marketplaces for videos, for ebooks. Like, if you count the number of objects that are digital content online, it's like in the tens of trillions of objects. And if you think that like 1% of those objects might be like interesting and valuable, and if you think that like the value of those ones is like a penny, like if you do that math, like it's still just like an enormous market. And so the other interesting thing is, like, we've never really owned anything on the internet. Like, when you go read, Amazon ebooks, you don't really own the ebook. You own a license to the ebook. If you go watch a movie on Netflix, you don't own the movie. You don't own the rights to the movie. You don't own the royalties to the movie. You don't own the royalty stream of Taylor Swift's album Lover, and so on and so forth. So the idea is, like, once you can own the IP to this stuff, it unlocks tremendous value for the reason that you can put them on secondary markets and sell them.
Just like
that's it. So the reason that I'm excited about NFTs is partially because of art. I mean, I'm an artist. I think art is really cool, but it's primarily wearing my investor hat and saying, this is a huge financial asset class that we have never had before that is about to become liquid.
So what you're saying is, before the Sotheby's of the world, the Christie's of the world, there were like those private marketplaces for ultra rich. Now it's gonna come down to like even smaller, more simple assets, and even I know that you paint. Like, we have to reveal that to the audience, right? And I've seen those are beautiful paintings. So let me ask you one practical question: Have you ever tried to digitize your painting and sell it?
Absolutely. I'm actually an artist on Super Rare. And if you want to see some of my stuff, you can go to firstedition.xyz/jbrook. And I have a bunch of NFTs you could buy. I've sold a bunch of NFTs. I'm not a prolific like seller of NFTs. I don't have that much time to devote to this, but I've definitely sold a few pieces of generative art that I made and a few digital art pieces as well.
So how hard, like, again, a very practical like advice from you as a person who already sold your personal non-fungible tokens, right? So imagine an artist is watching this interview, right? And he's saying, wow, that's a great idea. I want to go and digitize my painting because I know, like, I'm a great artist, right? So what will be the first step?
Just go to async.art and engage those guys, and they have like this amazing onboarding flow that they're working on for new artists that will make it easy. If they just want to try it like right now, if they have some kind of digital painting or JPEG or something like that that they just want to try tokenizing, go on rarible.com and to the issuance section, and they have like a very user-friendly way you can log in with your phone, and try it out.
Perfect. Thank you. I think that will be valuable for people who are into this. So I know that, again, being a person, who like smart as you are, but also like, I'm sure you had a lot of interesting, versatile experiences, right? So what was the funniest thing, like, that you've experienced in the industry? Like, some comic situation, like, I'm sure you have a bunch of them.
I don't know. I mean, look, it's the blockchain industry has been a pretty small group of people by and large for a number of years. It's now starting to grow quite a bit, but it's a little bit. It's like working with colleagues, and a little bit it's like being with friends when you go to some of these conferences. Prior to COVID, I'm sure there's been a lot of stuff, but funniest experience. Ooh, I don't know. There's just been so much. I'll tell you this. My mind is always blown when something happens that like has never happened before. So when moments like when the DAO raised, $150 million in a week and then spectacularly exploded. When I saw sort of the first major cryptocurrency fork, of ETC and Ethereum parting ways, like, when I see like balancer pools just like raising liquidity overnight, things like that are just, you feel like you're part of, a process that is just so new and has never happened before, and it's very exciting. And of course, some of it is really funny because people just put a lot of memes out there, and investors really underestimate the power of icons and emojis and memes. And how they work to really build communities of these networks.
I see. So, and in terms of the book that you would recommend to people, like, if you want to dab into the DeFi world and understand better, like, more complex, I think maybe a research paper or book. Like, I know that you've published a lot of things on your YouTube channel and on your blog. Like, maybe some other experts that you think are great at explaining those, like, in a very simplified language.
Yeah. So I think most recently I purchased Camilla Russo's The Infinite Machine. So I think she did a great job of kind of outlining, the history of Ethereum, which I sort of lived through, at least from New York's perspective. And I think that's a great book to kind of get people into the mindset of, what it means to be crypto native, like what people went through to get to where we are today. And I've always been a huge fan of Andreas Antonopoulos and everything that he's produced. So all of his books, I think I highly recommend.
No, thank you. I've Antonopoulos, I've read everything as well, like, but I haven't bought yet, like, so I read her blog, that's a given as well, right? So that's a great job. So I mean, generally, I think we've covered a lot about, like the DeFi indexes and about your fun thesis, like, and I'm sure we can talk about about those things in hours, but I try. As I've received some feedbacks from the people like that, it's hard for them to listen about the technical stuff for more than 1 hour. So that's why I'm trying to limit it. But we are both in New York, so I'm happy to catch up more. And I'm really sincerely wish you well. And I know CoinFund is going to flourish regardless. And It's a great pleasure talking to you, Jake, and I'm sure we're going to see a lot of great investments from your side.
Thank you so much for having me, Constantine, and I really appreciate your depth as well. And you've asked great questions, and that's always really what makes an interview is what the questions are, not what the answers are. So appreciate you having me on.
Thank you.